I'm Batterman from Financial Fiduciaries. Thank you for joining us for today's webinar. Financial Fiduciaries and its sister corporation, Digital Trust, have been providing fiduciary management services to individuals for nearly 25 years. Over the past couple of years, we have expanded those same types of services that we've been providing for individuals to the mutual insurance company space. And in the process of doing that, I managed to develop a very unique and specialized set of services for mutual insurance companies so that managers and their boards of directors can rely on us in the management of the investments of the insurance company. In the course of doing that kind of work, we've had a lot of questions from managers, from the boards of directors, and so forth about various aspects of financial management services that we provide. And a lot of those have centered around the work that we do in fixed income, because of the conservative nature of the investment portfolios, a significant portion of all of the insurance companies' portfolios are invested in fixed income. And so what we've done here is we've assembled the various kinds of questions that we've been receiving and tried to provide answers to all of them in one spot here, not only to answer your questions that you may have today, but to archive those kinds of responses so that you can consult them in the future anytime a question in this area comes up. So we're delighted to have this opportunity and delighted to have you join us. A couple of things I want to talk about in terms of what we're going to do today. First thing we're going to, the big thing is we're going to look under the hood of investing in bonds. Basically, like going to your car and lifting the hood. We're going to do that when it comes to all aspects of investing in bonds. If you, either for your company or personally, are investing in bonds, you better do this stuff, or you better hire someone who does, because this is the key things that are necessary to do a proper job of investing in funds. We are recording this session, as I mentioned earlier, so we're going to have archive of this available to you or anyone else you know who might be interested in hearing this, but who is able to sit in on today's session. Those archives will be available for play via podcast off our website, perhaps on our YouTube channel or our Facebook page. Keep up for more information in that regard. Before I get into the subject matter of today's conversation, I wanted to just take one moment and remind you about the perspective at which we cover these issues, because it is quite different from the perspective that others in the financial advisory field might share. In order to focus on that perspective, I've got this chart here which attempts to compare different delivery models in different kinds of industries. We have some industries where the delivery model is designed around selling product. We have some industries where the delivery is designed around selling service. And then we have some delivery systems where the process is combined. And so, for example, if we look at a product sales kind of an environment, consider automobiles. If you walk into a Ford dealer looking for an automobile, the advisor or whoever it is going to help you there is going to try to help you find a car, but you well recognize going into that process that they're only going to be focusing on the vehicles that they actually have to sell. You understand that, and you understand that at the beginning of the process, and so you kind of have your radar up about that as you're being told these things by that salesperson. Similarly, your insurance agents, they're out there working with the public, have the same type of response from the public. They realize that your agents are trying to sell them something, and it's all part of the arrangement. But the important thing is everybody understands that's what the arrangement is. Then you go to the other side of the spectrum, service-oriented models, and we have things here like physicians and accountants. These are professionals who provide a professional service based on training and education, and pay them a professional fee for their service, but they're really in the business of trying to sell you any particular product or anything like that, imagine how you would feel if you went for a prescription to your physician and they wrote a prescription for you and you realized that they were getting a 20% commission on the prescription that they were writing for you. You'd have some serious question about the credibility of the objectivity of the physician's work. And similarly with accountants, you go to them to have them do tax returns, to have them do your audit work and so forth, but you recognize they're not there to sell you anything, they're just there to provide a service to you. And then we have combination type services, so for example, lawyers, some of the time they're providing services in fee-for-service kind of environment, and sometimes they're providing services in a contingent fee kind of an arrangement where their compensation is going to be dependent on whether they can get you to settle a case, for example. And we have auto mechanics. I don't know if any of you have had the experience, but I certainly have, where you go into the auto shop, they have them change oil and rotate your tires, and all of a sudden they come back with this whole list of other things that you got to do, and you wonder, is this because I really need this, or is this because they're selling things? But the point of this is we have all delivery models in other spheres of our existence, and we understand what's going on. The difficulty that we have in financial services is we have those same three types of delivery models, except it's all extremely confusing because everybody calls themselves the same thing. And so I apologize for the fact that it's so confusing, but let me try to help you understand what that difference would be. The vast majority of people that are in the financial services industry, calling themselves advisors or wealth managers or whatever they are actually brokers, and they're actually working in this model. They're giving advice, yes, but their advice is designed to get you to buy what they have to sell, very much like the Ford salesperson's job is to advise you to buy a car, but that car is going to be a Ford. On the other side of the spectrum, we have independent fiduciaries, or fee-only, is a way to think about this. These are organizations or individuals who provide financial advice and financial advisory services only for a fee, very much like what the physician does or the accountant does. There's no sales component to this. They're not there to sell you anything. They're just there to provide you a professional service. And then we have those in the middle, which in the industry we call dual registrants. Sometimes you see them out in the market calling themselves fee-based advisors because they're trying to get themselves to sound like they're fee-only advisors, but they're really not. They're fee-based advisors. And these are individuals who want to be able to position themselves as providing fiduciary-like services, but yet they still have a significant portion of their revenue that comes from selling you what they have to sell you, similar to what the auto mechanic might do. This unfortunately, again, all three of these different delivery channels end up calling themselves a lot of the same things, so it's very confusing and great in this environment out here, the fiduciary fee-for-service kind of space that is completely independent from sale of any particular product or anything. And the reason I want to go through that is because there is a point in here where that distinction is very important to understand in terms of the advice you're going to receive on buying and selling bonds specifically. One thing, this category right here, this is the vast majority. There's very few of these right here. This number is increasing more and more because more and more of the brokers are trying to position themselves to be able to claim that they're providing services like that. And as I was preparing for this session today, I got this email right here, which talks to this process of migrating from the side over to the middle. This is a guy talking to people who are out selling insurance right now, calling them advisors, of course, the point I was just making. Out of this insurance salespeople, and he's trying to say why should they become registered as advisor representatives like the fiduciary model, which is what he's talking about. And he's suggesting that there's three reasons. One is protection from regulation. And what a great reason. That's exactly what the public wants, don't you think, is people that are doing this stuff to be protected from regulation. Number two, earn significantly more income. I think is truly an interesting observation, because he's suggesting that the reason people should do this is because they can earn more income from it, not because it's better for the customer or anything like that. So, as I said, I received this right in the midst of preparing for this session, and I thought it underscored why it is that we've got people moving from the left over to the middle, but folks are way over on the right and providing the true fiduciary type services that we provide. With that background, I'd like to get into our discussion for today. I wanted to do, because many of you are familiar with certificates of deposit and many have extensive or sometimes only investments in CDs. I wanted to just review what's involved with those investments and review them as investment vehicles. So you go to the bank and take out a CD, recognize that you are loaning money to your bank. You're giving them the money and they're giving you a promise to pay. They're going to pay you a specified rate, and they're going to do that for a specific term. So say you're going to get 1%. That might be hard to do even today, about 1% for 2 years or something like that. And you know you're going to get the interest, and then you know you're going to get your money back. Again, but it's a loan to the bank. You reckon that there's a penalty for early withdrawal, so your money's pretty much tied up there in the bank. And if you want to get it out early, you can, but you're going to pay a penalty to do that. In play, we have FDIC insurance to secure the bank's obligation to repay. And that came about after the Depression, because people were concerned about banks repaying at that particular time, and so we've got FDIC insurance. Now, we all recognize that the FDIC insurance has limits. It's $250,000 per depositor. Just a reminder, we wrote about this in our insurance newsletter here recently, but we used to do unlimited FDIC insurance for non-interest-bearing deposits, but that was removed, and the $250,000 limit now does apply to all types of deposits, including non-interest-bearing deposits. So if your organization is in a situation where you are maintaining bank balances in excess of that amount, you may want to consider either opening a deposit account with a different bank, or you can consider using what's called a repo agreement, where the bank actually pledges CDs out of its investment portfolio to you as collateral for the amounts in excess of the FDIC insurance limit. This is a very safe way. I would submit it's perhaps even a little bit safer than the FDIC insurance amounts. Unfortunately, there may be some variability in how the commissioner looks at these repo agreements. I've heard some say commissioners told them that they're perfectly fine with that. I've had other cases where I've heard that the commissioner views that as a type 2 investment because it's in excess of the FDIC insurance limit. So just be mindful of that if you get into that situation. But that is a situation with CDs. Now, the question is, you loan your money to the bank, and as we've been focusing on what their relationship is with you, but then the question is, what do they do with your money once you give it to them, once you loan it to them? Well, what they're going to do is go out and invest it in something that's going to earn a higher interest, so they can pay their costs and all that kind of thing, and still have enough left over to pay you what they obligated to pay you. They do a couple things. One is they lend money to businesses and individuals and so on and so forth, but they also have a significant part of that money is investing in bonds, investment grade bonds of the type that we're going to discuss here today. So the point is that if you invest in CDs, you basically are hiring the bank as a middle person to be in between you and investing in bonds. You may benefit from considering getting rid of the middle person and going investing yourself directly in the same kinds of investments that the bank would use. And that's what we're going to explore here today. Bonds are basically of the same type of structure as a certificate of deposit. They're a loan to the issuer. They have a fixed term and a specified rate. So you might invest for 2 years at 1% interest. It's like you have with a CD. Unlike a CD, the repayment obligation may or may not be insured. There is no FDIC to insure these kinds of things, but there are private insurance companies that do offer insurance. Some bonds are insured, some are not. So, but there is that possibility. Issuers of these bonds would be U.S. government. When we talk about the federal debt, that's what we're talking about, is these bonds that have been issued to the marketplace. State and local governments can issue bonds. So the state of Wisconsin, your cities can issue these bonds, and school districts. Many of those issues are federally tax exempt. Some are even double exempt. So you don't have to pay tax on the interest that you're in there. And then there's corporations. So the corporations will issue these debt instruments to the market. GE, Morgan Stanley, Goldman Sachs, Hewlett Packard, so all over the board. But so the issuers can be the government, U.S. government, state and local governments, or corporations. What we're going to focus on here today as an example that we can continue to refer to as we go through this is a PE bond. So let's say that General Electric comes out and they need to borrow $15 million. So they come to market with a $15 million bond issue, and the terms are that they're going to offer a 2% interest rate on the bond. The bond is going to be a 4-year bond, so it's going to be issued today and it's going to come due in 4 years, 3 years, pardon me, February 28th of 2016. And let's say that you're going to buy $100,000 of this $15 million bond issue. Just wonder if you about this particular purchase on your part. Aspects to consider. Number one, when you go in to buy this bond, and you're getting a $100,000 bond and you're paying $100,000 for it, it's common to think that there's no compensation. You're getting it from a broker, but there's no compensation involved. Well, that isn't really how that works at all. Just to get a little insight into that transaction, what happens is an investment banker or a brokerage firm will go to GE and they'll either have a contract where they get paid a very large sum of money to distribute this bond, or sometimes what happens is they'll go and they'll say, look, we'll buy up this entire $15 million bond issue for $14.5 million. And then they go out and they sell it for $15 million, and then the difference between that is what their compensation is. So when you get these calls from brokers saying, yeah, I got this bond today, and we're selling it at par, which is $100,000, they can think about the fact that, well, their mother organization has probably bought a big group of this bond, and they're incenting their brokers to get out there on the street and get it sold. So that's how that kind of a transaction works. With a bond for $100,000 and you buy it today, it's going to pay, typically going to pay interest 2 times a year, every 6 months. So you get an interest payment on February 28th, and you get an payment on August 28th. So if you buy it today, typically the first payment will come on August 28th, and then every 6 months thereafter until maturity. Of course, at maturity, you're going to get your money back, assuming that GE doesn't default on its obligation. So $1,000 every 6 months, and then $100,000 back at maturity. One of the issues with this is what I just said. So, are you going to be repaid? And differences are there in that regard. Now, as I said, some of these are insured, some of them not. Many of them actually are not. And so it's where the rate agencies come into play. It's their job to go out and assess payment risk associated with these different issuers. And there's 3 primary ones, Standard & Poor's, Moody's, and Fitch. The Commissioner's Office is more focused on S&P ratings and the Moody's ratings. But that's their job, is to go out and assess the risk of repayment. As I said, some of these bonds may be insured, And our insured, of course, that's going to increase the rating. Many of the there's very few AAA issuers out there anymore. So many of the bonds that come out that are AAA rated, it's usually they're AAA because they have some sort of insurance backing them. And we need to be mindful of the fact that just the bond comes out with a rating at the beginning, it doesn't it's going to stay that way throughout. Many of us remember when the U.S. had its credit rating downgraded here, I think it was in August of 11, so about a year and a half ago. Example of this point right here, ratings do change between the time that the bond issued and maturity, so it's something that a bond investor needs to be mindful of. And also understand that the rating is very important to the issuer because, we'll touch on this a little later, but the higher the rating, the lower the interest the issuer is going to have to pay to get people interested in purchasing the bond. And the lower the rating, the higher the interest the issuer is going to have to pay. So it's really in the issuer's best interest to try to get this rating as high as possible so that they can pay the least amount of interest. As the bond ratings go, here is a ratings chart that shows how these ratings work. And what are considered to be investment grade bonds, these are bonds that you can invest in, these are bonds that you are able to invest in as a town mutual insurer and still have them classified as type 1, would be bonds from this line and go up. So you see we've got the prime, high grade, upper medium grade, and lower medium grade, and those are all considered to be investment grade bonds. You see here for S&P, rated at AAA, all the way down to A minus, and then we get into the triple B plus, triple B, and then triple B minus. Triple B minus being the lowest rating from S&P that you will buy as a town mutual insurer. And then over here we have the Moody's scale for rating these is also a B. AA B by Moody's should be very similar to a triple B minus by S&P. Now, as far as the OCI rules about bond investments, many of the insurers have bond investments that are categorized as type 1 investments, but there are some rules that you must follow in order to have them categorized as type 1 investments. The commission rules say you must have a triple B or better rating from S&P or Moody's at the time of purchase. I always find that to be kind of an interesting rule because when you go back here, Moody's doesn't have a triple B aspect to their rating, so I'm not really sure what that means. The other interesting thing about this is it says at the time of purchase. So presumably, if you have a triple B bond at the time of purchase or better, it's going to be a type 1 investment regardless of if the bond's rating gets downgraded to below triple B. That would be arguable under the way they have this written in our position that if it's below triple B, it's no longer investment grade. We did, for the purpose of assessing the portfolio compliance of our clients, treated as a type 2 non-compliant investment because we think they should be triple B throughout. And you also have to have a final maturity of 15 years or less to be a type 1 investment. So you can have an A-rated issuer, but if that bond doesn't come due until 2033, maturity of more than 15 years, it's not going to qualify as a type 1 investment. Some bonds could be type 2 investments. So, like I just gave you, where you have an A-rate issue, but it comes due in 2033, it'll be a type 2 investment because it's otherwise eligible as an investment, but the final maturity is out beyond 15 years. And we also have unrated bond of a Wisconsin municipality that would be a type 2 bond investment. So these don't have to be rated at all, and they'll be categorized as a type 2 investment. But the catch is they've got to be a Wisconsin municipality. Now, we've seen some cases where there are corporate bonds that are rated and that the interests have been sold by brokerage firms. Well, those are not even really qualifying investments. We've seen issues where, in one case, for example, a California bond was not rated. And yes, it was a municipal bond, but it wasn't a Wisconsin municipal bond, so it too was not a qualifying investment. So you can have bonds that are not type 1, but there's some pretty significant limitations on those. So let's take a look here at the liquidity of your bond investment. Similar to CDs, except for the fact that unlike CDs, they can be converted to cash prior to maturity. So you don't have the situation like you do with a CD where there's an early redemption penalty or anything like that. We can convert our bonds to CDs, our bonds to cash if we need money in these ways. One that comes up is through a call feature. What happens in this situation is the issuer has an arrangement from the beginning that says that at such and such a date, if I want, I can call this investment away from you at a designated price. So, for example, on our GE bond here that's issuing day, GE might have the right on February 8th of 2014 to call that bond away from us and pay us $100,000 for that bond. That would be an example of a call feature. The point to you here that call features are really not advantageous from the investor's standpoint. And the reason that is that if the bond rate is too high, the issuer is going to call that bond away from you. So, for example, you get this G bond at 2%, and next year the market rate's down to 1%. Well, GE is going to call this away from you next year and reissue at 1%. So this can be taken away from you against your will. On the other hand, if interest rates spike, if rates go up to 5%, what do you think is going to happen when this opportunity comes along? GE isn't going to exercise it because if they called in your investment, they'd have to turn around and reissue it at 5%. So they have all the cards in that situation. It's really disadvantageous from the investor standpoint. That's how an investment can be converted to cash, is through the exercise of a call feature. Another thing that can happen is there can be a redemption offer, and we've seen an unprecedented level of activity in this regard right now. In other words, there's no obligation for you to sell your investment back to the issuer, but the issuer will come along and say, hey, I'd like to buy this bond from you, and here's the terms on which I'd like to do it. We see 2, 3, 4 a week here lately. What the companies are trying to do is they're trying to buy their bonds back and turn around and reissue them at lower rates to restructure their debt at lower rates. So it's bad because you have an ability to say, no, I don't want to do it. I'm not happy with that price. But that's another way that you can convert a bond to cash. And a third and very common way, of course, of converting the bond to cash is through a secondary market sale. Just like you can sell stocks and those types of investments out in the secondary market, you can do the same thing with your bonds to convert it to cash. Now, enter into a secondary market type of a purchase or sale of bonds. Get into the issue of how is the price established on these bonds. Let's look at this situation right here. We got a $100,000 bond that's paying interest at 2%. This GE bond that you just bought. Let's say between now and the end of the year, interest rates go up, and you want to sell your bond at the end of the year. So if interest rates go up to 5%, your bond, you can do that. The question is, are you going to get more or less than $100,000 for it? Of course, the answer to this would be you get less. An investor coming at the end of the year, if they can go on the marketplace and get 5% on an investment in another opportunity, that doesn't mean they aren't going to buy your 2% bond. they'd be happy to buy it, but they're not going to pay you $100,000 for it. They're going to pay you something less than that in exchange for getting a lower interest rate than they otherwise could get in the marketplace. So that's one influence on bond prices. Another possibility would be, let's say, interest rates drop. So we have our bond at 2%, and let's say rates drop down to 1%. Now you need to sell it, you need to pay some hail damage claims. Are you going to get more or less than $100,000 under that set of circumstances? The answer here is you're going to get more in that situation. So if I wanted to buy this bond from you, and it's paying 2%, and I can only go out and get 1% by investing in something else, I'm absolutely tickled pink to be able to buy your bond and receive 2%. But because it's a good deal for me, you should demand a little higher price than the $100,000, so I have to pay you more than that to buy that bond from you. Here's an illustration of how the movement of interest rates affects the prices on bonds. So right here is 0, no movement. So we issue this bond at 2% interest, and interest rates stay flat, and it's not going to affect the bond price at all. But if interest rates go down, this blue line is interest rates. So if interest rates go down, it's going to cause the value of these bonds to go up. And I'll come back to these different lines in just a moment. On the end, if interest rates go up from the percent to 5%, that is going to cause the value of bonds to go down. So there's an inverse relationship between the direction of interest rates and the value on these bonds. Different lines here are referred to something that is called duration. Duration is, in simplest terms, to maturity on the bond. And what duration does is it affects how much the bond's value is going to change given a particular move in interest rates. So for example, right here we can look and see if interest rates go down 1%, the value of a bond with a duration of 1 is going to go up 1%. The value of a bond with a duration of 2 is going to go up 2%, and the value of a bond with a duration of 3 is going to go up 3%. So that's the effect that duration has on the movement of the value of the bond for a given change in interest rates. And you see the same thing over here. So if interest rates go up by 1%, bond with a duration of 1 is going to drop by 1%. Bond with a duration of 2 is going to drop by 2%, and the bond with the duration of 3 is going to drop by 3%. So but it's just an illustration of how changes in interest rates affect the prices on the bond. Terminology in here, of course, duration is what we were just talking about. Approximately average maturity is sort of how you can think about it. That's not technically correct, but you can kind of think about it that way. But really what it is it's a measurement of the amount by which the bond's price will be affected by a given change in interest rate. Other concepts that are related to this, one is a premium. So in other words, if the bond's value increases, we're going to pay a premium. So we said before, if interest rates go down to 1%, we're going to pay more than $100,000 to acquire that bond yielding 2%. Well, that difference between the face value and the market value is going to be a premium, an amount over the face value of the bond that we're willing to pay to acquire. You have a discount, and a discount would be a situation where the market rates have increased over the interest rate that's being paid on the bond, and so we'll still acquire that lower paying bond, but we're going to pay face value for the bond. We're going to pay something less than face value, and so that gives rise to a discount, which is a situation where the face value exceeds its market value. difference is called a discount. So, for example, one here, just illustrating. Let's say instead of owning that $100,000 bond, someone else does, and we want to buy it from them. They own that 2% GE bond, and we're going to buy it from them, and rates have fallen to 1% in the meantime. We're going to pay a premium, assume, of $3,000 to that bond because $1,000, I mean, calculate what the proper amount would be, but this is just an illustration. We're going to be willing to pay more than the face value of the bond to acquire that bond because it's paying a higher rate than the 1% that the market is willing to give right now. The question is, if you do that, so to pay this $3,000 premium, total $103,000 to buy the $100,000 bond, what happens to that extra $3,000 when the bond matures? And the answer is it goes away. So you pay $103,000, and at maturity you're only going to get $100,000 back. So you're losing $3,000 on that transaction. Conversely, you can have it the other way. So you want to buy this bond at 2%, yielding 2%, but the market rates now have risen to 5%. As we said, we'd be willing to buy that bond, but only if we can do it at a discounted rate. So we're going to pay $91,000 to buy this bond because it pays 2% interest. Well, we paid $91,000 for a $100,000 bond. What happens to that $9,000 difference between what we paid and the face value? Really, the extra income to us at maturity. So we paid $91,000, but we'll get $100,000 at maturity, get an extra $9,000. Concept: the $3,000 that you're going to lose if you buy a premium bond, or the $9,000 that you're going to gain if you bought the discount bond, gives rise to the concept of amortization and accretion. And those that have studied your annual OCI report have probably noticed some entries on that report regarding amortization and accretion. Maybe you completely understand it, but if you don't, here's a little explanation of what that involves. You paid a $3,000 premium to buy that bond, and you're going to lose that $3,000 when it matures. The question is, when do you book that loss? And the answer is required for both accounting and tax purposes to analyze that loss each year over the remaining life of the bond. So, in other words, you're going to lose $3,000. That's over a 3-year period. So it's going to come due in 2016. So, one way to do it would be you're going to book no loss in year 1, no loss in year 2, and then you've got $3,000 loss in year 3 when the bond actually matures. But what amortization requires is not that it says you're going to book a $1,000 loss in year 1, a $1,000 loss in year 2, and then a $1,000 loss in year 3. So it amortizes out the loss so you don't have it hit all at once, both for accounting purposes and for tax purposes. Here's the other side of the coin. So now we bought the bond at a $9,000 discount. We paid $91,000 for a $100,000 bond. When do you recognize that gain? Well, if we didn't do an accretion, the gain would look like this. There would be zero gain in the first year, zero gain in the second year, and then $9,000 a gain in the third year. But again, that's not what they should do for accounting purposes or for tax purposes. So what happens here in this situation is you recognize a $3,000 gain on that investment in year 1, $3,000 gain in that investment in year 2, and then a $3,000 gain in year 3. Again, level out the option in that value of that bond. So all this gives rise to the concept of yield to maturity, the prices, premiums, or discounts, and so forth, gets us to the value of the bond. And now we have to use that value to calculate something that we call yield to maturity. This is not only the best, but the only proper way for determining the fairness of the price of the bond that you're buying. It's a mathematical equation, so makes people's eyes glaze over, but we'll try to work this and give you the sense of what it entails. Well, review what happens with the actual cash flow on an investment like this. Let's say we're going to pay $103,000 to acquire this $100,000 bond, paying % per year. What is our cash flow on that situation? Well, we receive interest payments, but those interest payments are $1,000 per year or $1,000 every 6 months. We get the $1,000 on August 28th and $1,000 on February 28th. So the interest payments that we receive are not affected at all by what we've actually paid for the bond. If we pay 103, if we pay 110, if we pay 90, none of that is going to change what we're going to get in interest. Our interest is going to be the coupon rate multiplied by the face value of the bond, or 2% times the 100,000, or it's going to be $1,000 per year. How much receive when this bond matures? Well, the answer, as we've discussed before, is just $100,000. So you paid $100,000 for it, but you're going to get $100,000 at maturity. So $3,000 premium that you paid is lost. So, in summary, you've invested $103,000 in order to receive $2,000 per year in interest and $100,000 cash at maturity. So the yield to maturity is the mathematical calculation assuming your investment amount is $103,000. You're going to receive the $2,000 per month in interest, and you receive $100,000 or book $3,000 loss on this investment at the time that it matures. Yield to maturity takes into account all those factors and says, all right, what really is the yield that we're getting on this $103,000 investment, and the $2,000 per year, excuse me, not per month, and $3,000 loss at maturity. So is the yield to maturity, taking these into account, going higher or lower than the bond's 2% coupon rate? And the answer is it's going to be lower. We're investing more than $1,000 to get 2%, so it stands to reason that the yield would end up being lower on $103,000 than it would be on $100,000. And that's the reason that you had to pay a premium to buy this bond, was that the interest rates had fallen down to 1%, so our yield to maturity is going to be lower than the 2%. The important step here is that the yield to maturity is going to be similar and reflective of the general interest rates for all instruments of similar quality and maturity. So if market rates are 1%, you're selling a 2% bond, the that bond is going to be such that when you run this yield to maturity calculation, the maturity is going to be about the market rate of 1%. We're dealing with instruments of similar quality and similar maturity. Another example, assume we paid $91,000 to acquire this $100,000 bond. Now it would be, will our yield to maturity be higher or lower than the bond's 2% rate? You can understand that the answer to this is higher. We're earning 2% on $100,000. Percentage is going to be a lot higher when we've only invested $91,000 to get $2,000 for an interest. So you get $2,000 per year in interest on the $91,000, and then the extra $9,000 at maturity, and so the yield is going to be higher. That's because the reason you're buying it is that the rates were higher than the 2% rate that the bond is paying. So again, the reason that the discount comes into play is that on other investments in the marketplace you could get 5%. So this bond drops enough so that you can buy it and get a yield to maturity of approximately 5%. Question to illustrate yield to maturity in a different way. Which of these bonds offers a higher yield to maturity? So we have bond 1 that has $100,000 face value due February 28th of 2017, so this is 4 years. And 5% interest. And you have $100,000 for this bond. So $100 4-year investment at 5%. Or bond 2, $100 face value bond, you only pay $90,000 to acquire this bond, but it pays 2.5% interest. Comes due the same time. Bonds offers a higher yield to maturity. Think that one for a minute. There is either. Actually, yield to maturities of both are essentially the same. And for that is, take a look here at the cash flow of this. So bond 1, you paid $1,000 for that bond. You get $1,000 each year in interest, and then $100,000 back at the end. So total interest received is $20,000. There's no on your original investment because you're getting exactly what you paid. So your total return on that investment is $20,000. Over here on 2, we only need $90,000 for that bond. We owe $2,500 per year in interest. That's 2.5% on that $100,000. So we only got $10,000 worth of interest, but we paid an extra $10,000 on that bond because we put $90,000 into it and we got $100,000 back. So when we add interest to the gain on our original investment, we got $20,000. We made $20,000 on both investments. So essentially, their yield to maturity is the same. So you can hear that the pricing adjusted to reflect the interest rate on the bond that bond is paying can get you to the same. Can have bonds that provide the same yield regardless of the price that you paid. Let's look at the $100,000 2% coupon bond one more time. And we looked before at the fact that if you paid $103,000 to acquire this bond, that yield to maturity would be lower than 2%. Which is true. All right. Now the question is, if you pay $104,000 to acquire that bond instead of the $103,000, would your yield to maturity be higher or lower? And the answer there is that it would be lower because you're paying even more to the same stream of payments, and so that is lower here than it's here, and it's certainly going to be lower on 104 than it is on 103. So that is, in 103 you paid 102. Would your maturity be higher or lower paying 102 versus 103? The answer there is it would be higher, because just like we looked at in the other situation, the less we pay for the yield to maturity, and the more we pay, the lower the yield to maturity. Relates to the fairness of prices that you're going to receive on bonds, whether you're on the buy, sell, or the sell side. By the side, all transactions go through the secondary market and all accomplished through a brokerage firm. And the question is, how do you know whether the price you're paying is fair? Or do you know if you're trying to sell a bond, the price that you're being paid is a fair price? A transaction usually works. So I'll tell you the situation that we have seen that is up, and this is how the process goes for most investors in bonds, whether they're insurance companies, individuals, or whatever. Broker, who again might be calling himself an advisor, might even be calling himself a fiduciary, but at the end of the day, they have some profit either directly or indirectly from the transaction. They call up on the phone, they say, hey, guess what, I got a bond available today, I'm going to sell to you at this price, it pays a coupon rate of this, and it comes due on such and such a date. What do you think? You look at that and you think, yeah, I could use that. We get extra cash laying around, and sure, go ahead. That's normally how these things happen. Well, in that situation, you've just been had. Any clue what price you paid was fair or not? If the fair price on this bond was 3, you don't know if you paid 104. You don't know if you paid 102. All you know is they called you and they said, here's the price, and you said, yeah, go ahead and do it at that price. So you really don't know whether the price was fair. Market trading in bonds is similar to dealing in used cars. The goal of the broker in the secondary market area is to profit by buying a bond from somebody for as little as possible and then trying and selling it to someone else for as much as possible, like a used car. Fortunately for you, and this is the key point right here, oftentimes the broker is going to set the price not based on what is fair or anything else. The only determinant of price is going to be the level of sophistication of the buyer. They're going to price that bond at whatever the market or whatever they see you as being willing to bear on that price. There's a interesting set of information that bears directly on this point. A couple days ago, we went out to the market to take a look at some pricing, or various pricings offered on exactly the same bond. So here's a Hewlett-Packard bond, okay, issued by Hewlett-Packard, and I apologize if this is a little small to read, but I'll go through some of the details with you. The coupon rate, or that's the interest rate being paid on the bond, is 2.15%, and the date is 9/13 of 2015. Okay. The rating on this bond is Baa1, triple B plus. So it's an investment grade bond, not A, but kind of triple B. So those are the details on the bond. But the point I wanted to make is this. This is a list of offerings by different brokerage firms for this exact same bond. And look at the difference in prices at which this bond would be sold. Here's this right here. You can go to this in this bond for $100,000 bond for $101,588. All these are different prices. And down here, the highest one, if you want a broker, you pay $102,096. So the point of this is that when that broker calls you and says, here's on, what do you think? And you go ahead, you have really no idea where you are in this spectrum. Are you here paying this for this bond? Are you here paying this price for this bond? Are you somewhere here, paying the price for the bond. You have absolutely no idea. And look at how the price bond affects the yield maturity. Here is the yield of maturity on this bond. At this price, it's 1.482%. Down here, at this price, it's 1.159%. So it's over a 0.3% difference in yield because of the different prices at which this bond is being offered by different brokerage firms. Another interesting point here is to look at what they're doing if they want to buy this bond from you. So here's what they're willing to sell this bond to you for. Here's what they're willing to pay you to buy this bond from you. So $100,386 is what this broker is willing to pay to buy this bond. So they're going to buy it from you for $100,376, and they're going to turn around and sell it for $101,891. So $15 difference on a $100,000 bond between what they buy it from you for and what they'll sell it to you for. Here, it's even worse. $100,540 is what they're going to charge you, or what they'll pay you for your bond, and they're going to charge you $102,400, so a $1,900 difference between what they're willing to pay you for your bond and what they're willing to sell it to you for. And this is the whole point of this whole exercise. You've got to do your homework. You've got to look at what the resulting yield to maturity is on the bond. Given the price the broker wants to charge, you determine whether that price is fair. And this is the key difference between what kind of an entity, between the different kinds of entities that you might be dealing with this transaction. Because if you're dealing with an entity that is in one of these two areas right here, they're going to be from the transaction, and so they're likely to be a higher end when they're selling this to you, giving you what they feel like, you know, the typical bear before you'll get too nervous about it or whatever. When you're dealing with somebody that is in the fiduciary mode, the fiduciary is going to be out there understanding this is what goes on, trying to get you down to this level in terms of a price you would pay to buy. In fact, they may get you down more to this level here and close this gap. And similarly, if you're going to sell bonds, they're going to try to get that price increase for you. Interestingly, if you look at the difference, if this was a $100,000 bond, and you look at the difference in price between buying the bond at this price versus buying the exact same bond at this price, the difference there is going to be $800. One of the things we have when we talk to boards of directors of mutual insurance companies is they say, well, we got to pay you a fee. You know, we're concerned about having to pay you a fee. Well, look at here, an $8 difference on one bond transaction would be enough to pay a fee for over 2 years for work in guiding on this kind of thing. So this is where just to focus on what you're paying for fee maybe loses sight of how all this works for you. Our job is to try to get those prices down as much as possible. Touch briefly on the concept of accrued interest, because this is also involved, and then we've had a number of questions around this issue as we talk to directors and managers and staff members. Remember, funds typically pay interest semi-annually, so we talked about an interest payment on February 28th and an interest payment on August 28th. But the fact is that each day you earn interest on every single bond that you own. So in our example, $100,000 2% bond pays $1,000 today, or it's issued today. So as of today, there's no accrued interest on that bond. So it will accrue 555 cents of interest. That's $1,000 that's going to earn over the course of the next 6 month divided by 180 days. So it's going to earn $5.55 of interest tomorrow. And that's going to happen every single day until it next pays interest of $1,000 on August 28th. That's how interest accrues every single day. But the question is, what's this accrued interest when you go to sell or bond? So this bond is earning interest every day. What happens to that accrued interest? Well, the answer is it gets calculated and included as part of the purchase price. So you're owed that money even if you sell the bond in between interest payment dates. So here's how that works. You got this bond and you decide to sell it, $1,000 bond on March 20th for $103,000. What is going to be your total purchase price? Well, of course, we decided to buy that $100,000 bond for $100,000, but we've got accrued interest, so we earned $5.55 per day, and there's been 20 days since the last interest payment, so those $111. So that bond is sold, the purchase price is going to be $103,111. So $103 for the original bond and then $111 of accrued interest. That gives rise to the concept of purchase interest. The $111 that you paid is called purchase interest because you purchased that at the time that you acquired the bond. There are questions about what the proper accounting treatment of it is. We've had people that have recorded this as a negative income item. We've had people that have ignored it until they actually receive the $100 interest payment on the bond. The proper accounting treatment is that this $111 show on your balance sheet, not on your income statement, but it goes in your balance sheet as an asset. It's an asset receivable. You're owed $111 out in the future. And then when you receive the $1,000 interest payment on August 28th, is $11 of it goes to eliminate your asset receivable, and then there are $889 posts as interest earned because you didn't own the bond before March 20th, so you're only entitled to actually earn the interest from March 20th until August 28th, and that's $889. So that's typically how these transactions are supposed to be handled when it comes to purchasing accrued interest in a transaction. I had to comment briefly on some generalizations about yield. Generally, longer maturities are going to yield more than shorter maturities. So if you're willing to bond that's 20 years until maturity, you're probably going to get a little bit more yield on that than you will get on something that's only got 5 years to go to maturity. Quality bonds have higher yields than higher quality bonds, and we touched on that earlier. So if you get a bond that's like a B rating or a double B rating, the interest rate on that bond is going to be higher than the rate on a double A bond or an A bond. The reason for that is that the issuer's got to pay more interest in order to have the market have enough interest to buy that bond. That way, sometimes brokers will come in and they'll sell you bonds that have yields, and I'll hear people say, "Gosh, I got this higher yield," but then we go look at the quality of the bond, and the quality of the bond is like trying to compare that yield against the amount of bond where the quality is much higher. That's not an apples to apples comparison, and not a basis for a decision. And also taxable bonds typically have higher yields than tax-exempt bonds. You have to pay interest on tax on your interest on your tax-exempt bonds, or at least not federal tax. And the corresponding offset on that is then the interest rate isn't quite as high on those investments either. So those are some generalizations about yield. So you may have heard about the yield curve, and it's just an illustration of what the yield curve looks like. The yield curve simply just means that the further out you go in maturity, the higher the rate of interest that you're going to receive on the investment. And generally, this is the general shape of the yield curve where each increment time period you go out, you earn higher rates of interest, and eventually that starts to flatten out, and so for going out additional periods, you don't get nearly as much interest anymore. So the trick to this is to try to find a spot here where the yield curve stops steepening so much, it starts flattening out more, and that's typically about the spot where you want to maximize your long investments. If you were 10 years, and at 10 years you can get 0.1% more interest than you can get at 9 years, does it really make sense to tie your money up for 0.1% when interest rates could go up and leaving you holding an investment that's yielding an inferior amount? So how the yield curve looks and how it steepens at these shorter maturities. Another important point is this: a lot of times people approach their bond investments in this way right here. Your bond, it's a good quality bond, and yep, that's it. I got it, and that's how it's going to stay, and it's all good. I don't have to worry about it. Well, it really isn't true. There are things that happen over time. Ratings can change. We talked about the U.S. government debt being downgraded a year and a half ago, but that happens pretty regularly, and a lot more so these days than it used to happen. We've seen situations where ratings deteriorated and no one was paying attention, and the value of the bond was basically completely gone. Went from $3,000 down to virtually nothing. And the insurance company didn't realize it until it was at nothing. The reason that is no one's watching it. The manager wasn't watching it. The board of directors weren't really paying attention to it. And understand that if you're working with a broker, they have a reason to continue to monitor that investment. They've sold it to you. They've made their money on that deal, so there's really no reason for them to continue to monitor it. So these rates change, but sometimes there's nobody watching over that stuff, and that's how that kind of thing can happen. Rate on bonds that need to be evaluated. As I said earlier, we've seen an unprecedented level of activity in that regard just recently, but it does come up quite frequently. We just had a case here a few weeks ago where we had a $20,000 bond for an insurance client that was going to come due in December of this year. The issuer came along and offered us an exchange of some common stock that had turned around, sold us the common stock, was to get us $30,000 for this $20,000 bond. It wasn't an obligation, it wasn't a call, it was just a redemption offer. We looked and said, by gosh, that's a pretty darn good deal. Convert our $20,000 with 10 months to go into a $30,000 investment, and so we accepted that offer on their behalf. But these come along and they need to be evaluated. You can't have your head in the sand about opportunities that arise. And it may present opportunities to change the taxability or the maturity of the portfolio, and that needs to be evaluated. We've seen quite a bit of activity in that regard over the last year to 18 months as interest rates have fallen off the cliff. The values of these longer-term bonds are at a high point with interest rates being so low. And so it's an ideal time to look at selling those longer-term bonds, convert them either into something much shorter so that you've captured that high value and now you've got an investment that's going to come due much sooner in case rates do go up, which we think they are going to go up eventually, or perhaps change the taxability. If you're being taxed on your total earnings, including underwriting income, and that if you've had underwriting years, maybe you don't need municipal bonds anymore in your portfolio, so it's an ideal time to cash out of the ones that you do have, capture maximum value in them, and then turn around and invest in a taxable bond. Got some losses to show the net earnings from taxes for a period of time. I mentioned really about custody issues. The regulations require that you either maintain these bonds registered in your own name. So what that would mean is if you bought a bond You have to have it actually issued to you, and then you'd be holding it in your own vault. That would be a very cumbersome process for you. Or you can have them deposited with a qualified custodian. But understand that a qualified custodian is a bank or a bank trust department. It is not a brokerage firm. We've seen a number of situations where insurance companies are keeping funds, but they're keeping them custodians that are not qualified under the regulations, and that's a problem for you. What you need to understand is that qualified custodians charges vary quite significantly. We recently did a survey of custodian charges in this space, and we found prices that range all the way from 5 basis points with no transaction fees on the low up to a fee of 20 basis points, some transaction charges on the hand. So, for example, if you've got a $2 million investment portfolio for your insurance company, on the low end, that's $1,000 a year, and on the high end, that's $5,000 a year, and you got transaction charges on top of that. So, a significant difference in the charges of custodians. Insurance companies are pretty sensitive to costs, and so they think about paying a professional like us a fee as a cost, and there's some resistance around that idea. They also resist the idea of paying a custodian a cost. But to encourage insurance companies, remember that it is not no cost for you to have to administer your own assets. You got things you got to take care of, like you got to process maturities, you got to figure out what you're going to do on the reinvestment of that, you got to get the interest in, you got to make sure you're accounting for it and doing all those kinds of things, and those are all things that are automatically taken care of for you by a custodian. So while you may not see those costs as readily if you don't have a custodian, they're there, and they are substantially reduced by using a custodian. Unfortunately, they may not always show up so much on your financials, that we well recognize that investment costs, investments receive an allocation of some of your other costs, and part of the reason for that is that your testing and underwriting percentages and ratios are areas that get looked at pretty closely, and so by putting those charges or costs over in the investment area, they don't affect your underwriting and loss ratios, but unfortunately it means that the savings that you might actually have on your asset administrative costs don't jump out at you out of your financial statements, but they are there nevertheless. Other concern: recognize that zero coupon bonds are prohibited. We've seen some insurance companies that have had investments, and they're simply not qualified investments. Interesting question has been some U.S. government savings bonds. We've got companies that have these U.S. bonds where you pay an amount, you don't get interest payment during the term, and then you just get a lump sum at the end. That's essentially a zero coupon. So there might be an issue with that. The commissioner at this point hasn't raised an objection about it, but there may be an issue with those. But that's what a zero coupon bond is, where you pay maybe $70,000 today, and you're going to get $100,000 in 5 years, and you're not going to get any interest payment in between, just an increased value. One of the things that are prohibited is that the line of bonds offer a huge opportunity for brokers to mark up the bonds without significantly affecting the yield, and so it's really a great area for you to lose a lot of money in markups, and I think part of the reason that they're prohibited for town mutuals. Bond mutual funds and bond exchange traded funds are excellent alternatives to consider under certain circumstances. Recognize that they are type 2 investments, and so unfortunately if you're having struggle meeting your type 1 minimum requirements, you can't look at those types of investments. But if they are if you do have room in your type 2 allocation, these may be investments that are worth looking at. Bear in mind, though, they would need to be custodied properly, so you can't custody these at a mutual fund company. You can't custody these a broker account. You really have to have a qualified custodian to custody these investments. We've seen a whole lot of collateralized mortgage obligations sold to insurance companies. They're a pain to administer because not only do they have monthly payments of interest, but they have principal balance, so you're constantly adjusting the principal value of your investment in addition to the interest payment. And no matter how good the issue is, can be an aided issuer or even a U.S. government issuer, they're type 2 investments because of the nature of the investment. So we really steer completely clear of these kinds of investments. But if you are using, make sure you recognize they're type 2 and aren't going to be with your type 1 requirements. And finally, be concerned about structured products. Specifically, we've seen some certificates of deposit. They're marketed as CDs, but then they do things like offer the stock market return or return tied to some commodity or something like this. Essentially, inside of those investments are going to be derivatives. And I wasn't there myself, but my colleague Greg was at the Mutual Day down in Madison. Maybe you were there as well. And apparently there was some comment by Commissioner, I don't know if that was in a formal presentation or privately or whatever, but expressed some concern about insurance companies being sold these kinds of investments and the exposure to derivatives inside them. So be careful that you know what you own. You either got to figure out what you own or you hire somebody to help you figure out what you own because you don't want to have those things. A pretty opportunity to share this time with you here today. Hopefully the information we've provided has been helpful to you in understanding how bonds work and maybe some understanding aspects of that as they appear in your financial statements or the investment report or whatever. If you do have questions about any of this, please feel free to contact us. Here's my email address, our company Financial Fiduciaries, our website. Here's our toll-free telephone number. Feel free to drop us an email, give us a call. And if you know of anybody else that would be interested in this kind of information, please share it with them. Well, to view this, be accessible, as I said earlier, on our website and hopefully through some of our social media channels. Thank you for doing this with us, and we will hope to see you soon.